Welcome to the FedLife Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife Podcast. As you probably guessed by now, from the dulcet tone of my voice, I'm your host, Dan Sipe. Additionally, I am also the branch manager here at Lee Sipe & Associates and Serving Those Who Serve. Begin as I always do. Thank you for taking the time to listen, and above all, thank you for your service. You don't hear it enough. You're always going to hear it here and as part of everything we do at Serving Those Who Serve. The other thing that you will hear is the guru. He's back again. He's part of our ongoing mission to reach, teach, and serve you. And as I always have to say at the outset that the opinions of our guest, Ed Zerndorfer, are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you do not have a personal advisor, you are not alone in the world. You can come to our website. You can ask questions at stwserve.com. We will take care of you. Once again, as is our wont, we will follow Ed's FedZone articles to give you and us one more way to reach and teach. We're back and kind of continuing on a theme about retirement and working. In the last podcast, we covered the topic of reemployed annuitant, and in this one, we talked through phased retirement. I think this is going to be a hot topic for people. I think a lot of people are going to be interested in it. And then we'll wrap up with taxation of employer-sponsored life insurance like FEGLI. So, Ed, you're pretty clear that you think the phased retirement and reemployed annuitant conversations should be linked in contrast and compared and contrasted. Tell us why, in general, you feel that way, and then we'll dig in.
Yes, Dan. We have to remember that the federal government, and this has been going on, I'd say, for at least 20 years, is looking for talent to fill particularly important positions. Over the past 20 years, think what's happened between security and then in recent year or two with COVID. They want to get people who have the skills, And it's getting hard to hire these people. For one reason or another, federal employment is not that attractive. People think they can make more money if they work in private industry. I tend to disagree. You just can't look at a salary. You got to look at all the benefits. In my opinion, the federal government has such wonderful employee benefits, particularly when it comes to health insurance. It is what it is. Particularly young people are just more interested in making the big bucks quick, and they see these opportunities, and they're not coming to the federal government. So, reemploying federal retirees to come back is one way of retaining their skills, and this has happened with the years. But there's another aspect to this. It's called phased retirement, where an individual has the skills, has been working for the government for many years, and they have the skills, and these individuals have the ability to train newly hired employees coming in, so that this person who is eligible to retire fully would be able to train someone to take the positions. And it's very, very important that this position be filled. But the agency has to give some type of incentive for this person not to fully retire.
Gotcha.
On another level, Dan, I'd like to say this. I think the idea of phased retirement, in which you are partially retired, you're going to go back to work part-time, is very attractive from the following standpoint. And this is what I tell individuals when I teach the retirement classes. Let's understand that retirement can be a very scary time. And you say, what are you talking about? I says, well, it looks great on paper. It really looks great on paper. I'm going to be retired. I'm going to look forward to retiring, do the things I always wanted to do. I can't wait. Maybe after you're retired and you're waking up in the morning and you don't have to set the proper goals, after a while, it's going to get depressing, because let's face it, when you're working, it's a discipline. You got to go to work every day.
Sure.
You have to produce. Certain things are expected of you. It's a discipline, Dan. When you're retired, you are your own boss. And you have to set the goals, what you want to do, and hopefully you're going to accomplish them. You got to do something. And
that makes sense.
To go from working full time to not working at all, it can really be psychologically devastating after you retire.
Gotcha.
With phased retirement, you are not going from working full time to not working at all. You are partially retired. You're working part-time. And this will ease you into that part. By working part-time, it'll ease you into that time that you're not going to be working. And That's the first thing. The second thing we got to keep in mind is, from an economic standpoint, when you're working, most employees, especially at the end of their careers, are earning a good salary. When they retire, hopefully their retirement income, and I always recommend that you need to replace a minimum 70 to 80% of that final gross salary with retirement type income if you're going to retire to a high cost area of the country. Maybe 60 to 70% if you're going to retire to a not so high cost area of the country. But here's my point, Dan. It can really be a shock economically once you retire that you don't have this nice huge salary, but you're still going to have the bills. By sort of gradually getting into retirement, getting, let's say a 50% phased retirement, in which you're getting 50% of your annuity, we'll talk more about that, and getting 50% of a salary, it'll sort of prepare you economically for the time that you're going to be fully retired, gradually getting into it, as opposed to going totally cold turkey in which you're not getting a salary, you're only getting the retirement income.
Gotcha. Okay, so what are the rules? So I'm a Fed, I'm working for an agency, I'm an impact player. I kind of want to go out. They kind of don't want me to go out. So what happens next?
Well, let's be clear on something, Dan, that phased retirement is not, I repeat, is not an employee entitlement. It's not a given that when you retire, your agent will say to you, okay, you can retire as a phased retiree, meaning you're going to partially retire and which means that you'll get half of your retirement annuity. And if you come back, and if you retire half, let's say 50% retirement, then you come back and work, we'll give you 50% of your salary. Mm-hmm. It's not a given. The agency has to get permission to offer this type of retirement, phased retirement. It's not a given. I will tell you, getting back to what I said about employees who have certain skills, that the agency needs to really retain the skills of this employee through hiring new employees, and this person will train those employees with these skills. That would be one aspect of one example of an agency that really would like to get permission to offer phased retirement. But I want to emphasize again, it's not a given. It's not a given. So if an employee is working for an agency and they have given permission to offer phased retirement, they should talk to their HR department or personnel office to see if they would be a candidate for phased retirement.
You kind of touched on it. So some of their income is going to come from their salary and some of their income is going to come from pension. The salary can still have benefits deducted, correct?
Oh, yes. And let's talk about those benefits. Again, this is different than being a reemployed annuitant, because with a reemployed annuitant, you're getting your full annuity. And then you come back, work as an employee, and as we mentioned earlier in the earlier podcast, that your salary, your annuity, is offsetting the amount of your salary. But with a phased retiree, they're going to get if they do what's called a 50% phased retirement, they're going to get 50% of their annuity, and then they'll get 50% of their salary. Now, with the salary, they can have all the benefits as they did as an employee. And let's go through some of these benefits. The federal employees' health insurance. If the same individual is 50% retired and they were eligible to keep their health insurance for retirement. They were participating in the federal employees' health insurance for the last 5 years of their federal before they retired. Then they get to keep that health insurance. And annuitants pay the same percentage of the premiums as employees, namely roughly 25 to 28%. A phased employee, getting back to my example of a 50% phased retiree, phased retirement individual, they're getting 50% of their salary. Now, normally, Dan, if you are a part-time employee, you're working less than 80 hours a pay period. So this phased retiree is working, let's say, 40 hours a pay period. They're working half-time, 50%. You pay proportionally more for your premiums to take into effect that you are a part-time employee. So a part-time employee who's working 40 hours a pay period would pay on average about 40 to 50% of the FEHB premiums. But that's not the case with a phased retiree. They're going to pay 25 to 28% of the premiums, plus the insurance premiums will be deducted from their gross pay, as opposed to their being deducted from their after-tax annuity. So that is a big benefit. That is a big benefit that, again, you do not have as a reemployed annuitant. Let's just talk about what's called the basic insurance amount. The basic insurance amount is your salary, your SF50 salary. That is your salary that shows up on your SF50 every year. So let's say when you come back as a phased retiree, your SF50 salary is $100,000. Mm-hmm. Well, if you are working half-time, your coverage, your salary would be roughly $50,000 then. But in the case of FEGLI, if you were to die in service, your beneficiary would get the $100,000, not the $50,000. Again, you're working part-time. The other benefits including flexible spending accounts. You can put in the maximum amount allowed. Even though you're a part-time employee, you can put the maximum amount into the FSA, healthcare FSA or dependent care FSA. You have access to the federal employees dental and vision insurance program, FedVIP, and the federal long-term care insurance. You can if you apply for it and get approved for the federal long-term insurance, again, those premiums will be deducted from your paycheck. And how can we not forget the TSP, Dan? The TSP.
We could never forget that.
Never forget that. You can contribute to the TSP. The TSP as a phased retiree. There's no age limitation here. How much you contribute? The same amount that all employees are allowed to contribute each year. Like, for example, in 2021, you can put a total of $19,500 into the TSP. If you're over 50, which most probably a phased retiree would be, you can put another $6,500 in the catch-up contributions for a total of $26,000. And if you are a FERS phased retiree, you're going to get agency matching.
Nice.
Agency matching. Your contributions to the TSP are not going to be limited because you are a part-time employee. You're getting the best of all worlds here, Dan.
Gotcha. Okay, so from the salary, they're going to earn credits for an increase in their ultimate retirement annuity. And how do those work? Because I'm assuming that they'll be slightly different for CSRs or FERS depending on what plan they're in.
Yes, they're going to get, in terms of accrual factor, the percentage factor they use to calculate the annuity. That's correct.
Okay. And how about sick leave? How's that going to work into the equation?
Phased retirees accrue annual and sick leave according to the number of hours they're working each pay period. If they're half-time, working 40 hours a pay period. If they would be entitled to get 8 hours, and why would they be entitled to get 8 hours every 2 weeks? Because when they retired, they had more than 15 years of service. Mm-hmm. So therefore, they're entitled to get the maximum 8 hours every 2 weeks. But if they're working, let's say, 40 hours as a part-time employee, they would be entitled to get 4 hours of annual leave and 2 hours of sick leave. Everybody gets 4 hours of sick leave every 2 weeks. That is if they're a full-time employee. So in this case here, as a phased retiree working half-time, they would get a 2-hour accrual in case of sick leave every 2 weeks.
Gotcha. And the final calculation leads to a composite annuity, right, that the Fed would draw at the end of phased retirement.
That's correct. That's correct.
So tell us about that.
Okay, so again, like any annuity, it's calculated, CS refers, it's going to be based on your high 3 average salary and your total credible service. So in the case of the high 3 average salary, under both CSRS or FERS, the high 3 phase retirement annuity is the amount of the 3 consecutive years of salary, as of the, well, let me back up here because we're recomputing it now. The annuity would be calculated as high 3 average salary as of the day the person retired as a phased retiree. So they take the 3 consecutive highest years of salary. And by the way, those 3 consecutive years of salary are based on full-time service. They do not reduce it by the phase percentage, would say whether it's 50% or 40%, they get the full credit. And the other component is the total credible service. And total credible service used in the phased retirement annuity is the amount of the employee's credible service as of the day before the effective day of the phased retirement election, and then they add to that the additional years they worked as a phased retiree. And unused sick leave, the unused sick leave will be added to their existing unused sick leave that they had when they initially retired. So that will also add to their total credible service, leading to a higher composite annuity.
So, all right, drum roll, please. So let's wrap up this segment, sort of tying together our previous podcast and this one about reemployed annuitant or phased retirement. Is this going to be another one of those famous patented Ed Zerndorfer 100% unqualified it depends?
Absolutely, Dan. They both have their advantages and they both have their disadvantages. And there's another option here. That besides being a reemployed annuitant or a phased retiree, just go out and get another job, and receive your full annuity with all the benefits. I get this question: what do you think is better for me, to become a reemployed annuitant, or should I become a contractor, work as a contractor, and for an agency? I said, they both have their pros and cons. They both. I cannot tell you which one is necessarily better.
Sure.
It depends. It's a matter of running the numbers here to see what's best for you. There's certainly room for some maybe making some just down to earth calculations. And one shoe does not fit all. It really depends on the individual.
Couldn't agree with you more. Spot on as always, my friend. Okay, so it's time to head into our last topic, the taxation of employer-sponsored life insurance. And I guarantee you people are going to be, when they hear this, because it's people that they just don't think about it. So we're talking federal employee group life insurance. And for a quick recap, so we can kind of steam into the taxability parts, there's 2 general components to FEGLI, and that's the basic life and the optional coverages. And am I correct that the taxable component is primarily going to be around the basic?
That's correct. And the reason for that, Dan, is because when it comes to the FEGLI basic insurance amount, and people ask, what is the FEGLI basic? It is usually your SF50 salary. Every year you look on your SF50, you're going to see a salary in there. You take that salary and you round it up to the next $1,000 and add $2,000. So, for example, right now you're looking at your SF50 salary on your SF50, and it says your SF50 salary is $102,300. $102,300. Okay, so Dan, let's round it up to the next $1,000. That's $103,000, and add $2,000. That means that your basic FEGLI basic insurance amount is $105,000. If federal employees who are enrolled in the FEGLI basic, they pay 2/3 of the premium cost, and their agency pays the other 1/3.
Okay.
Other 1/3. We're talking strictly employees here. They pay 2/3 of the premium cost, and your agency pays the other 1/3 cost. There's also the optional coverages. Option A, which is what's called standard, flat $10,000. And then we have option B, multiple of one's salary, SF50 salary, rounded up to the next $1,000. So you can get 1, 2, 3, 4, 5 multiples of that adjusted salary. So my example here, the person's salary is $102,300, rounded up the next thousand is $103,000. So who's enrolled in that employee, if he or she's enrolled in option B, they could have 1, 2, 3, 4, 5 times $102,000. But here's the point, Dan. Employees pay the entire premium cost. There is no government contribution for the terms of the cost for the premium cost for the optional coverages. I left out one other optional coverage. That's option C, called family coverage.
Yep.
But again, if an employee is enrolled in that, they're paying the entire premium costs. The only thing the government, the agency, is paying for on behalf, contributing in terms of the premium costs, is the basic coverage, Dan.
What might those tax ramifications look like? So let's go back to your person that's 102 rounded up, so 105,000. So what might they be seeing in the way of a tax bite?
Well, let's be clear on something, that when it comes to group life insurance policies, if an employer-sponsored group policy like FEGLI, and this is not a FEGLI rule, this is an IRS rule.
Sure.
IRS says that if an employer is paying part of the premiums, they're contributing to the premium costs. The good news is that anybody who has an employee who's a beneficiary of a group-sponsored life insurance policy, employer-sponsored group policy, the first $50,000 of coverage is tax-free.
Gotcha.
But if you have more than $50,000 of coverage, IRS says that any excess of group-sponsored employer group-sponsored health insurance policy in which the employer is contributing part of the premium will be potentially subject to income taxes. When I say income taxes, I'm also including not only federal income tax, I'm talking about Social Security tax up to the annual Social Security maximum wage base, as well as Medicare Part A, the hospital insurance payroll tax. It shows up. If your FEGLI if an employee's amount of FEGLI basic is over a certain amount, that $50,000, then it's going to show up on the employee's W-2 that they get every January as taxable compensation. As you know, Dan, I have accounting and tax practice, and it never fails every year. Somebody comes to my office and says, "Hey, Ed, I got this on my W-2. There's something I don't understand. It says in box, I think it's box 14, it has a code C. And I looked it up. It says cost of employer-sponsored health life insurance. What is this all about?" And I got to go through it with them. And they said, "That's no good. I was told that life insurance is tax-free." Let's be careful here. Tax-free means that when you die, that life insurance policy that you have, and when it's paid, the proceeds are paid to the beneficiaries. It's income tax-free to them. And why is that? Because when you paid the premiums for that policy, your contributions were non-deductible. You didn't get any tax benefit when you paid the premiums for that policy. The proceeds that go to the beneficiaries upon your death will be income tax free.
Gotcha.
But the employer portion of the portion of the premiums that the employer is paying, if they exceed $50,000, will be taxable. It's really a taxable benefit to you. Gee, I got to pay tax on that, and my beneficiaries get this tax-free treatment. That's not fair. I say, I don't write the rules.
The older you get, and I know this used to be called a PS58 table, right? Back in the day?
They still call it the PS58.
Oh, they do?
table.
Okay.
Yep.
Okay.
And I reproduced it.
I'm just used to all my terms aging out. So yeah, folks, be sure to head over to the Fed Zone on that, because the tricky part of that is the older we get, the more the insurance technically costs as far as the economic benefit, and that's more that could be included in our salary. So be sure to get there. There's some great examples, and then you won't be surprised. So Ed, on this topic of the taxability of life insurance premiums, basically under employer-sponsored life insurance, any closing thoughts?
I think it'd be a good idea for our listeners to read my column where I talk about it. And I have some examples, Dan. I always give examples, as you know.
Yep.
That column appeared on September the 20th, it was about a month ago, in the Fed Zone. So please go to that column if you want to read more about it. It's a lot easier if you see it in writing. I try to write it so everybody understands them. And Dan, with your permission, can I make another plug for our Serving Those Life Insurance webinar? Because one of the things we talk about during our life insurance webinars is the tax ramifications of owning life insurance. We talk about that during our webinar, and I just happen to have our tax webinar date. I have the date. Right.
Let them know. Let them know.
Our next Serving Those Who Serve, Understanding Your Life Insurance webinar will be held on November the 12th from 9 a.m. to 12 p.m. Please go to www.stwserve.com. I'll repeat that, www.stwserve.com to enroll. It's free. It's a great webinar, like the rest of our webinars. And while you're on that website there, you can see about all the other webinars we give. We give on average, Dan, about 7 to 10 webinars each month. I give them together with Jen Meyer and Matt Kramer. Great co-hosts. We really enjoy doing this. And I think, and if you've never attended a webinar, any webinar, whether it's on FERS, taxes, TSP, long-term care, we have webinars on Social Security, FEHB. We're doing an FEHB webinar next, FEHB and Medicare webinar next Tuesday, the 26th from 1 p.m. to 4 p.m. You can sign up for that. By the way, folks, you know what's next month, Dan? It's open season. Maybe
yes, it is.
Take that. It would be a good idea to attend that webinar to learn up what choices you're going to be making on the open season. So again, we have the FEHB every month. Our next one will be next Tuesday. Very timely in terms of the open season coming up next month.
And if you missed that one, just grab the next one. And what I'm fond of saying is, when you get to our website, it's what you have time to do. If you got 10 minutes, grab an article and read it. Grab a blog and read it. If you got 30 to 40 minutes, listen to the podcast, share it with somebody else. And it's only going to take you 3 hours to do a webinar. And we vary the times. So the whole thing here is, this is a place where you can come and find answers and find information. Sure, we're a financial advisory firm. You want to talk to us about that, we're thrilled. But if you just want to get in, figure out how things work, understand the situation with no strings, that's what you're going to see. So I'm gonna close this with merciful sakes alive. The guru has done it again, and that might become a thing, Ed. I may keep that. I like that. With tough topics broken down just for you. So on behalf of the Feds, thank you, Ed, and on behalf of Serving Those Who Serve, thank you for being such a special part of our mission. You're a blessing, and we're all very lucky to have you. And folks, that is a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and also on Spotify. Please remember to share it with friends, strangers, even your enemies. Check us out on Twitter and LinkedIn. Don't forget the live webinars Ed mentioned. That's every week, stwserve.com. You'll see the big blue webinar button right at the top. Go ahead and click that. The guru will come to you. Sign up for one, sign up for all. Be sure to read Ed every week in the Fed Zone, fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, it is your Fed life, so make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.